our continuing series on the 2022 free ICT mentorship on YouTube. We're looking at the E-mini S&P June contract for 2022 daily chart. All right, so I'm going to teach you a little bit about intraday profiles and daily range, and we're going to be using this idea here. So initially on Twitter, if you were following me on that platform, I mentioned how I was going to start the day looking for a potential run to 4070. Okay, so 4070 was my initial draw on liquidity to see if it would want to reach down into that level. If you look in this area here, that's my fair value gap. And you can see we traded down into it here. Then today, one more time, we traded down into it, left these relative equal lows in place, and then started to move higher. I took everybody's attention to previous day's high and this high here. And if this continues to go higher, I mentioned this before, I can't recall what video, but I know I mentioned it in here. This is where we could potentially draw up to for an intermediate term target or objective. But I'm not co-signing that just yet. Right here and here is enough, okay? So we're expecting higher prices after this shift in intraday volatility. So we'll look at that now going to lower time frames. All right, here's the hourly chart. You can see how we did not take these relative equal lows out. I wanted to see it go down there. That's what I was looking for, to see it try to draw down into that. It didn't do it. It did not give a setup either based on the model I'm teaching you. So I used the intraday volatility and the framework to kind of like teach it today a little bit more about bias, how to change gears with your bias, how to also manage your bias. Okay, so initially in the beginning of the morning, I was looking for a potential run to 4070. It gave an opportunity to tape read, quote unquote, paper trade, or even demo using the draw on liquidity, but the model itself didn't materialize. Okay, so because I'm the author of these concepts, I have a lot of tools at my disposal, and I have a little bit better understanding of price delivery than the average student of mine. So if I go in and I show you something in this lecture today, the main takeaways before I get into it is this. What did I do and how do I go about abandoning a specific bias? How do I change gears if it is applicable? Sometimes it's not applicable to reverse. It just means move to the sidelines and just say, I'm not going to do anything. And what are the characteristics that would lead to a bias that is changed? And how do you use that logic going forward? And how to navigate the New York lunch hour. Okay, so we're going to tackle those topics in this video. All right, so notice that we had this low here taken with this run. Then this low was taken with this run. And this low was taken with that run. So notice what we were seeing. We're seeing multiple lows get taken, and then the market reverses while offering really no high probability shorting opportunity. The 4070 level never got tagged. Liquidity left in place. Okay. Previous day's high, which is here, that high was not traded to. So we have a high of 41.68 and a quarter, and then we have a fair value gap over here. So you have two premium arrays that may be a draw on liquidity. It takes us up in here and maybe even run above these relative equal highs. All right, on the 15-minute time frame, you can see how we just kept going lower than the previous lows. And then finally we had a run higher. So we had a short-term shift in market structure relative to the 15-minute time frame. Remember, that's our bellwether chart. So it runs higher, creates a fair value gap in here, and trades down into it here. Okay. So I was looking for 4070 today to see if it can get down outside the range of that daily fair value gap. And we failed to do so. And then the market shifted higher. Now, the whole time I'm looking at the market, it's not giving me any kind of short. I'm not comfortable taking any kind of short. And all of a sudden the market does this. Okay. No panic. No, I'm missing a move. No, calling somebody else or reaching out to somebody on a social media platform and ask them, what do you think's happening? I don't worry about anybody else's opinion. You shouldn't worry about anybody else's opinion either. You're going to learn how to trust yourself. So we had created a fair value gap here on the 15-minute time frame. So right away, that is your area to watch and see if price supports a run. If it digs into that and starts to repel higher, and we take out this short-term high, that is enough to set up a stage for the afternoon trend. Okay, Okay, that afternoon session move or setup or price swing, that's what we're looking for now. Because the market failed to go to an objective we were looking for, it was respecting that daily fair value gap, and it rallied up. And what fair value gap is that? At the beginning of the video, I showed you on the daily chart. Here, it took out that short-term high. So now we have an absolute market structure shift, bullish with this swing high, and the market comes back down in here and rebalances this fair value gap. Now, I'm not looking at, and this is where one of the instances where resistance broken turns support, but it digs a little bit past that. Okay, notice that it goes down into my fair value gap, not stopping dead in its tracks right at the high. Notice that? So I'm not looking at support and resistance. I'm looking at the fact that we went through this short-term high, created an imbalance, and then we traded down into that. And then when we get into this area here, I'm interested in looking at intermarket relationships. I want to study real accumulation and distribution. Okay, how do I do that? I've already told you. We're going to go into a lower time frame, 5-minute chart. All right, so here's the 5-minute chart. As you can see, the market did, drop down. It did real quick, sudden move after I tweeted saying that my initial interest was 40.70, and it started drawing lower. And then went one more time here at 10 after 9, took out that short-term low there, and then it started rallying higher at 9:30's opening. And then we dig down into that 15-minute time frame fair value gap. So it doesn't look like a fair value gap in here. Notice that? But I want you to go back to your 15-minute chart. This is where the work is required on your part. In this price run from here to here on that 15-minute chart, look at your chart and shade that in on the 15-minute time frame, and then drop down into the 5-minute, and you'll see how it drops into that shaded area. So we're working from a higher time frame, 15-minute bellwether chart, into a 5-minute chart. This is running into that fair value gap. Now, if you're just staying on one time frame, or at least not carrying over higher time frame analysis into your lower time frame, you're going to be trading blind. All right, so anyway, it digs down into that 15-minute time frame fair value gap here, and then rallies higher. Then it starts to trail off and goes down into this imbalance right here. Now, in that little stinger video, I draw this little area out with a rectangle, and I do a small little box up here. Okay, and what that box is if it goes down into here and starts to rally, I'm going to take half that position off once it gets into this area here again. Okay, I don't need to go above this short-term high. So that's what that little red rectangle represents. When you see me doing that stinger little vignette video on my Twitter feed, I'm drawing your attention here. So when we go from this level here, if it starts to rally up, once it gets back up in that area again, I'm going to take half the position off and then see if it can run above that high. Okay, so that's what I was drawing to. I'm drawing reference to that, so that way when I talk to you tonight, because this is our Tuesday lecture, I'm showing you now what it is that I was referring to and why it was there. Also, if you scroll back over here, you'll see it's an old area of buy-side liquidity here, and it's a fair value gap over there too. Okay, so that little rectangle here is drawing special attention to me reminding myself that over here, there's buy-side liquidity that is not showing in that video that I'm recording, and then that imbalance over here. So when it runs back up into that, this old area of buy-side liquidity, this might be just a stop run, and then they're going one more time passing into that level. So I want to make sure I get half my position off, because I could be wrong. Like I was wrong about 40.70, didn't trade to it. Well, here at 10:35, right there, 10:35 right there, I tweeted, I said, note your previous day's high. Okay, previous day's high is here. So if we add the annotations back to the chart, and we'll remember that 41.68, and what price is that? 41.68 and a quarter. So that's our high that we're likely to draw to. That's how I was kind of drawing everyone's attention to. And I'll now add the annotations back. So initially I wanted that 40.70 level. We failed to go outside the shaded area here. That's that daily fair value gap. So I've added it here for your edification. Notice that these lows here, this is lower than that one. Why is that important? Why am I drawing a distinction between those two? Well, if you go and you add your NASDAQ chart overlay, you'll see that this is a divergence. So even the S&P was relatively stronger than that of the NASDAQ. NASDAQ made a lower low here, okay? And I'll show you that before I close the lecture out. But for now, this is that 5-minute chart returning back into that 15-minute imbalance. So that's there for your edification as well. This is the opening price at midnight. That's what that level is. Now, I teach if we're bullish, we want to be buying at or close to the opening price. Okay. Now, here's one of those advanced ICT things. Okay. If you know that the market is likely to go down to go up, then you can wait for price to give you this type of setup right here, where it goes down, shift in market structure, come back down into a 15-minute time frame, fair value gap. This is intraday or day trading. It is not the model I gave you where it is a scalp. Essentially, that's what that is. The model I've provided for you for this YouTube channel is a scalping model. That's exactly what it is. But if you're going to day trade the daily range, you're going to be using the 15 and 5-minute chart. And there it is. Now, you can use that model that I gave you for entries and scalping. You can use that as your entry criteria, but with the logic and narrative that you're going to be trading the daily range. Okay. So if we're bullish, I teach and I have taught on this YouTube channel multiple times. My Power 3 concept is if we're bullish, we're going to be looking for the opening price at midnight. It's going to drop down, create the low of the day. It's forming it at 9:10 New York local time. It rallies up, shift in market structure. So it doesn't give me my objective, but it gives me these clues here. Now, the whole time I'm not tweeting to you. I'm studying price. I'm working with my son, and I'm measuring all these things. Because last word I gave on Twitter was I was looking for 40.70. No problem. No trade either. But I mentioned that there was no setup. There's nothing going on. And then the market rallies up. Okay. What I was looking for, it didn't reach it, and it didn't give me a setup. Did I lose any money? Did I take any kind of a painful ego twist to my arm? No. The S&T divergence here in the higher low versus the lower low in NASDAQ comparably. And then we have the shift in market structure. We trade back down into the 15-minute fair value gap here, and then we rally once more. Once I saw that, then I'm good to go. I'm waiting for the afternoon setup. But now watch what's happening. The market rallies up, falls short of 41.40. That was another level I gave in that little stinger video on my Twitter feed. So I'm going to count you to go over and check that out. And then it drops down into the fair value gap, starts to rally, but look what it does. It leaves these smooth relative equal highs. And then does what? Drops once more below that short-term low. Now, think about what I've given you in your notes as it relates to trading the PM or afternoon session. If you're bullish, generally what will happen is the market has ran higher in the morning, then it consolidates into the lunch hour. Then after the lunch hour, it'll drop down and sweep the sell stops or below some short-term low or the lows made in lunch. Okay? Now, watch what this does here. It creates a low ahead of the lunch hour at noon. Then it drops down into the fair value gap. Is that not doing what I gave you in terms of the rules of what liquidity is doing in the afternoon, post New York lunch, when we're bullish? Yes. What's different? It's not consolidating. You see that? Is this a consolidation? No, it's a retracement. So if you can identify an area where it's likely to retrace, and some of you asked on the Twitter feed, why am I measuring from here to get this versus this here to here? Well, you have to ring in what I'm trying to do. I'm trading the daily range. I'm trying to get the majority or the lion's portion of the daily range. So because I'm doing that, I'm factoring in that midnight opening price. So we've went above it here and once more. So I'm not expecting it to go back down below here again. So to refer to this low now, again, is pointless. I'm going to use this one here for market structure. So market structure, swing low here to swing high, that's my dealing range. So that's why I outlined that one here. Okay. And I gave you that small little rectangle up here, drawing my attention in the video here to go back to what I mentioned moments ago. That's an old imbalance, and it may stall here. It may fail here. It may just consolidate and then run for previous day's high, on Wednesday. So I want to take half my trade off, which is basically what you saw me do. But anyway, it's taking out that short-term low on a retracement. But if it was consolidating into lunch, I would look for the swing lows during the lunch hour and then wait for it to drop down, sweep them like it's doing here, and then rally. But because this is a retracement going into lunch, that to me, it signals that they're going to work through lunch. During the lunch hour, if it's a fast market, it's retracing back down in to a random fair value gap. It creates a short-term low, and then it runs the only short-term low that's there from here to here. This is too narrow. We don't want that. It's already moved too much. And it's going into that hour ahead of lunchtime, noon to 1, New York local time. So I want to see it retrace back down into a discount. How is that done? From that low to high. So the algorithm reprices to a discount once it gets to here. Then it does what? Creates that short-term low, rallies a little bit, leaves smooth highs in here. So what is that? They think that is resistance. So anyone that's short, they trail their stop loss here. And then it drops one more time right below that short-term low. What's below that short-term low? I have already told you here. Sell stops. So I'm thinking like smart money, this is going to go higher in the afternoon. Now, the market drops down into the sell stops here, and it's inside that fair value gap. And it's happening in the lunch hour. So let's talk a little bit about narrative. When the market shifted here bullishly, and it came back down into that 50-minute time frame fair value gap and rallied, this right here told me that they want to set this up for a bullish run in the afternoon. Why? Go back to that daily chart. Remember, we were inside this shaded area here. That's the fair value gap that I did not shade when we were looking at the daily chart naked at the beginning of the video. If you shade that on your own chart, you'll see when you drop down the lower time frame 5-minute chart, yours will look like this. So it dips down into that lower end of that fair value gap, and it rallies, trades back down into the 15-minute time frame fair value gap, which is what that is here. And then it rallies. Now, right away, in my mind, this tells me that the algorithm is priming itself for an afternoon run to potentially previous day's high, which is this level up here. Okay. So from here, right when it crossed over here, I'm thinking, okay, it could potentially be running previous day's high. I don't know it yet. Then when it drops down into here and then rallies from that, then I know it. Now that's narrative. Okay. By itself, it doesn't mean go in here and buy it because, hey, the narrative says it's going to probably run to previous day's high, because I could see myself stopped out if I'm premature. I want to see something that makes sense logically. So that means, do we see displacement? Yeah, we do. Is that an energetic price run? Oh, yeah, it is. Then that low to that high, I want to get that measurement for premium to discount. And what do I want to wait for? A discount. So I measured from that low to that high in that short little vignette video on my Twitter feed, and 50%, and went below that, and that's the fair value gap. So it trades down into it here, creates a short-term low, and then drops into it here. Now, what happens if it would have went here and rallied? Okay, well, I would have missed the move. But I'm looking for sell-side liquidity. I want to see a stop run, because what that's doing and how this fits into the narrative is, if I'm thinking that this move here to here and then retracing down is setting up an afternoon run to potentially this level here by the close of the day, I want to be like smart money and do what? Buy sell stops. That is buying sell-side liquidity. My order, as it's underneath here, I fill right here. I'm buying it on this candle right there. I know you probably don't believe me. I'm going to show you the candlesticks in a minute. But I drop down into it. I go long there, and then I wait for it to rally up. So it starts to rally up, and it consolidates a little bit in here, and then starts to almost come out above this high, and it creates a small little consolidation, and then pumps it through the old high and the 4140 level. Creates a short-term high, rallies once more. I'll draw a line on here because I want to see if price can be supported by that down close candle. That's the 8 order block. It trades through it, and once it did that, I nixed the trade. Okay, I have taken a lot of the trade off through here, and I'm also in an environment still inside that daily range of multiple days on the daily chart, where it might not go to previous day's high today. So this might be it, and it might need to use Wednesday's trading. So that was my thought process for closing the trade and protecting my stop loss, which never would have been hit because the stop was below here. But it came down, closed in this fair value gap, rallied again. This is an optimal trade entry once more, pushing it higher, but still did not hit the previous day's high. Now, think about this, folks. Think. At the beginning of the day, I tweeted public knowledge. I want to see initially if it wants to make a run down to 40.70. Okay. And as soon as I tweeted it, it was like off to the races it goes. Right in here. Boom. And then boom. And then drifted down to it here and made a low of 40.76 even. Didn't break out below the fair value gap that's formed on the daily chart. That's, again, that shaded area here. And I have this tweet here so you can see at the time at 10:35. That's when I said note yesterday's high. So that is there on this candle right here, 10:35. I'm tweeting note previous day's high. So I'm drawing your attention up here. So if a retracement comes back down into what I shared in that video beforehand, before it even came down here, I'm showing you this. And I gave you this level up here as previous day's high in chart format in the video, showing you that this is where my mindset is. I'm thinking, think up here. This is where it's going to draw to likely. And it's going to retrace down to this level here. So right away, this should tell you that for the folks that are paying attention, ICT says that it's probably going to go up in the afternoon. And it's probably going to gravitate towards this level up here, which is the previous day's high. And he's showing this level here where he's taught optimal trade entry, fair value gap. When it goes down to here, it's in what? A discount. So we're moving from a discount to buy sell liquidity. So the premium array is up here. The discount array is here. Doesn't it make sense for you to anticipate the move originating basically from here, running above here, taking a partial, and seeing if it can gravitate towards that high? Yes. So you study that way. So that's what I do with my students in my private group. That's what I'm doing with you. Okay.